A very good afternoon and a very good morning. Welcome to HYCM's workshop with myself, Giles Cochran, a Chief Currency Analyst. I do hope everybody's doing well. Hope you can see my screen and hear my voice okay. A lot going on in the markets right now, so if there's anything you're not on top of or don't quite understand or an instrument you want me to look at, please do ask me a question. Very happy to give my input and try to help out. Conscious there's a lot of different drivers going on at the moment, so we'll be doing that. Don't forget, as we look at different entries, exits, just as folks are coming into the webinar, this is not a trading signal service. The old like I do is you look over my shoulder, you see someone from a professional trading background, how I go about making my trading decisions. The key principle that I like to teach is whenever we're trading currencies in particular, we want to trade strength against weakness. Just as you'd imagine a strong arm overcoming a weak arm, that's exactly what we're looking at when we're trading currencies. We want to trade strength against weakness. And particularly today, we are going to be focusing on one event, which is the US ISM data, but also we will be looking at the FOMC minutes later on. So I will outline those for us. Now, as we go through the session, I will give us a quick overview of what's going on, because markets are so volatile right now that really have to do that. So if you've got any questions, any instruments you want me to look at, do just give me a shout. But I want to give us a quick overview on what's going on so we really understand these key drivers. Now, at the moment, what we're seeing is a sharp flush lower in commodities. Now, that's been the latest move. We can see gold, copper, silver, natural gas, Brent crude, WTI. WTI was down nearly 10% yesterday, Brent around 9%. We had nat gas down 3%, or 7% rather, and gold fell a whopping 2.38% yesterday. Now, also, iron ore prices are moving lower. So what's going on? Why are commodities moving lower? Well, now this has all been on growth concerns, that globally there's going to be a slowdown and a global recession. Now, we saw through COVID-19 there was a huge super cycle, wasn't there, for commodities? They gained and gained and gained, and then we started to see equity markets around the start of the year. They started to drift and fall lower. Okay, we've seen that carrying on. Now, that drift lower in equity markets, commodity markets kept surging higher. So you can see, look, when equity markets were falling at the start of the year, copper was still moving higher, Brent crude still moving higher, WTI still moving higher. So commodity markets hadn't fallen to the extent that equity markets have fallen. So that explains why recent commodity falls haven't been met with strong falls in equity markets. In other words, there's a lot of bad news already priced into equity markets. So equity markets are pretty flat, they're pretty range bound. Also, I want you to see this. Take a look here at this. It's not that chart. What is it? Which one is it? Here it is. Take a look at commodity index in the white line, and then look at the break-even inflation expectations. And what you'll notice is commodity prices and inflation expectations tend to move hand in hand. Now, that really does make sense. And the reason it makes sense is because commodity prices impact prices generally. So if the price of petrol is high, if the price of copper is high, if the price of iron ore is high, that means that the costs of goods and services are likely to rise. So inflation expectations correlate very closely to commodity prices, and you can just see how close those commodity prices and inflation expectations are impacted. You see the purple line is the commodity prices, and the rest of them are break-even inflation expectations, the 1, the 5s, and the 10s. So starting to see inflation expectations move lower is with commodity prices moving low as well. Now, if inflation expectations are moving lower, that means the interest rates are less likely to rise as quickly. So that's part of the reason why equity markets aren't seeing that same flush lower in commodities. So that's just an important distinction to understand about what's going on in current market dynamics. One other commodity to look at is gold. Now, gold had a big flush lower at 2.38%. Now, there was a very nice technical reversal signal. I was looking at trading that long.
And just going back to
I have my stop taken out at 1780 yesterday. With that surprise dollar strength that came in, now the dollar strength has come in on risk-off trading. Don't forget, one of the reasons that the dollar gains is when there's a global slowdown, and that's what the commodity sell-off is on the fears of, that tends to see strength come into the dollar, okay? And obviously the strong dollar is also making commodity prices even more pressured. So that's really weighed on gold. But the thing to understand about gold is that this dip isn't one to buy, because for gold to move to the upside, what we want to see real yields, and we want to see the dollar moving lower. Now, if you look at this chart, let me just show you what we've got. So we've got the red line is the dollar index. Now, that's been pushing higher. A strong dollar is a natural headwind for gold. That's headwind number one. Headwind number two is real yields. And for real yields, we're using the proxy of the TIPS, US 10-year TIPS, Treasury Income Protected Inflation Security. So in other words, this gives you an indication of nominal yields plus inflation expectations. And you can see real yields and the dollar's been high. So as long as real yields and the dollar's pushing higher, that weighs on gold. You can look historically, and you can see that when the real yields and the dollar index moves lower, that boosts gold higher. So there's still a pressure on gold to the upside. Now, you might have noticed nominal 10-year yields, you can see the blue line here, has been falling lower. But you can see inflation expectations have been falling more quickly than 10-year yields. So in other words, real yields are able to stay high because inflation expectations are falling more quickly, okay? So all of that means that this dip in gold is not one necessarily to buy, despite the strong sort of seasonals we've got for gold coming up. Around, mid-July to September, tend to see seasonal gains, and you can just see, average return of just over 3%. So that is just a little tour of what's going on. And the other thing to note is the majors. And you can see here, dollar index continuing to push higher, and that's weighing on the major pairs. Okay, they're all pretty much pressured by this dollar strength, and the dollar strength is what's pushing the majors lower. You see euro US dollar is really surging lower. Now, this dollar strength came after the July the 4th US holiday, and it's on that sort of risk-off trading. So as long as we keep seeing that flush lower in commodities, risk-off trading can continue. We could see some more of this dollar strength. But we have to recognize that the dollar is really at cycle highs. I've been expecting the dollar to push lower for some time now. And we've had very aggressive hiking expectations, but they're starting to pull back now. So in this context, today's ISM data and today's FOMC minutes will be very important to know what happens with the US dollar going forward. So first of all, I want to run through a little trade that I've still got valid from intraday basis today, which is the euro pound. I am got a sell order in place at that 0.582 region on the euro pound, and that is if we see a move back up here. I'm selling that just for today, and that was on that very weak PMIs prints that we had for the eurozone. Global construction PMI data for France and Germany. Look, can you see it's below expansionary territory? It's in contraction. for both France and Germany, as well as the Eurozone, the Purchase Managers Index is now in contraction. So in other words, markets are really concerned that the Eurozone is heading into a recession. So I'm expecting the euro to be pressured. So euro pound selling continues to make sense, and it does make sense today from an intraday basis. I've been selling the euro pound for a while, took most of my profits now, and I'm completely flat the euro pound, but I would re-enter if we saw a retracement back up to that pivot point today. Now, the risk event that we're going to be looking at in particular is the ISM data at 3 and the FOMC minutes. Now, let's understand where the dollar's at first of all, because we need to. Okay, let's go and take a look at the dollar. Let's go on to the weekly chart. Now, the dollar has been rising very strongly since the start of the year, and it's all been on increasing aggressive expectations for Fed hiking policy. Now, as of late, we've started to see some of those aggressive expectations unwind. Can you see the Fed fund futures? The Fed fund futures have pulled back from June, middle of June. We're expecting the Fed to raise interest rates to 4% by the December 2023. And now the Fed's only expected to raise interest rates to 3.2% by 2023. So in other words, interest rate expectations have been dropping recently. Okay. And here's just here's a little chart to help you. If you want to plot real yields and the dollar together, you can just use this use this symbol here. TIPS, just put TIP in, iShares TIPS Bond ETF. That will give you a proxy for real yields. Then uses the dollar index, and you can see how real yields and the dollar pushing higher, gold pushes lower. But if you look here, can you see when real yields and the dollar push lower, do you see how gold pushes higher? Real yields, the dollar lower, gold higher. Real yields, the dollar lower, gold higher. Real yields, dollar lower, gold higher, right? So here, if we start getting real yields and the dollar lower, then we should see gold higher. As long as they keep pushing up to the upside, that's a negative. So that's just a really easy chart for you to see. But the point I was saying is that aggressive Fed hike expectations are starting to be unwound. Now, the latest commitment for traders report shows that the dollar is quite at recent prior highs, around 1 standard deviation to the upside. So we can easily see some dollar retracement coming up. Okay. So do watch out for a dollar retracement. I use this with my friends over at Financial Source, got a good relationship with them here at HYCM. I work as one of their analysts as well. And this is what to look for as we go into the ISM print. Now, recently, we've been seeing some funny action to US data points. It's been trading counter-cyclically. So what I'm going to say now, you've got to try to use your wisdom when it comes to the print, because we have seen both a counter-cyclical and a cyclical dollar reaction to US data points. Now, prior to last week, we've been seeing the dollar respond cyclically. So in other words, bad data weakens the dollar, good data strengthens the dollar. That's the cyclical response. Now, the counter-cyclical response is when you see bad data, but it strengthens the dollar, and good data, but it weakens the dollar. Now, what I'm expecting is a cyclical reaction. So I'm expecting a big miss in the ISM print to be bearish for the US dollar. So the US dollar is at cycle high. The best opportunity will come from potential dollar weakness, and that will come if we get the ISM non-manufacturing, that's the services PMI. Now that's most important because 70% of the US economy is driven by services, if that comes in, and you can see the lowest expectation is 52.7, the forecast expectation is 54.3. So the tradable opportunity for me would come if we saw the print come in below 52.7. So if it's below 52.7, that should be dollar weakness. So then what would we like to trade? Now let's think, which currency pair would we like to trade dollar weakness against? I think probably something like the dollar yen. Shorts would make sense today. Now, if you just take a look here, we'll show you something. All right. If you just take a look at the yen, what you'll see is the dollar yen. The yen tends to strengthen over the summer months. You see here? So what's today's date? The 6th. So you can see from the start, from the 6th of July into the summer months, you tend to see the yen strengthen. That's dollar yen downside. That's the yen strengthening. And then look at the pound yen. Okay. Right. You see the yen strengthening. Look at the CAD yen. I think there was a good sell bias on the CAD yen, by the way, at market. Look at New Zealand dollar yen. Right. Look at Aussie yen. Right. Do you see that predisposition for yen weakness? It's very much there in the market. Okay. So that means that if we get a miss in the data, then we'd expect US dollar weakness and dollar yen downside would make sense. So let's just go and have a look. The majors. We'll try and have a look. I want to look on what I call my technical charts. I want to have a look at it here. There's the Aussie yen, Euro yen. Euro yen's a definite, yeah. Any retracement back up to the, for those of you like swing trading, right? Any retracements back up to 139, that's suitable for shorting. Stay below that trend line. Stay with it after the fears of global recessionary fears are glowing for the EU recession as well. So that makes sense. CAD yen. Got the Bank Canada meeting next week. CAD's been sort of quite heavily now, if we get the CAD break below that level on the daily chart today, that's suitable for selling from market. Stops above 105.67, target into 1.233. That's acceptable. And looking at the dollar yen, this will be on the ISM miss. Let's see what technically you can look at. Oh yeah, very nice. You can just very simply go with this technical break of the 4-hour trend line. So we just very simply taking that stay above, stay with, get below that level, sell, stops above the 13557, okay, and then looking for a move back down towards that 134 region. Okay, very nice. So dollar yen downside makes sense. That would be on an ISM miss. Yeah, a lot going on, right? Now, then we've got the FOMC minutes later today. Now, okay, so if it's a beat, there's no trade because that's just what everyone's expecting. Okay, the trade is on the miss. Now, with the FOMC minutes, if we have any sense in which the Federal Reserve is worried about a US slowdown, then expect upside in equity markets. So that would be a buy the S&P 500, buy NASDAQ, buy Dow Jones. You'd also expect to see dollar weaken. So that would be like buy, probably, let's think which pair would be good. Yeah, buy dollar Swiss franc. That's in the situation where the minutes give some indication that the Federal Reserve is going to be more conservative about hiking interest rates. So, sorry, it wouldn't be buying dollar Swiss franc. We'd want to be selling the dollar. So it'd be something like buying like pound US dollar. We've got to be careful of the pound with the UK political risk, but that should be all right. So if that comes out more dovish, I think I'd probably buy New Zealand US dollar or pound US dollar today. If it comes out hawkish, then there's no trade. We're looking for a dovish shift from the Fed because the dollar's been bid for a long time. The commitment of traders report shows a lot of traders are very heavily biased towards the long side. We want to see something that gives us reason for those buyers to close their position. We want to see something for the buyers to retrace. So anything dovish, just like a miss in the ISM PMI data, with the best opportunity for the US dollar, dollar yen downside would make sense. That's a dollar yen sell, and use those trend lines that I looked at. But the bottom line is the dollar you need to look at. You just got to make sure you get the pairing right today because there's a few different drivers out there. Yeah, Ian, hi. Right, Ian says, I'm long New Zealand dollar Swiss franc. Like how it fell hard lately, getting below August 2020 lows and also last month's lows. Given that we're now in a new quarter or so, fundamentally, are there risks to this trade? I know you are bullish on Swiss franc, yeah, but this pair seems to be performing better than the likes of the Euro Swiss franc. Nice. Okay, Ian, good work. Right, let me talk you through what my perspective is on this. Thank you, Ian, for a specific example. It's always helpful to have someone who outlines their position, you know, well, like you have done there. Okay, so what's going on here in the New Zealand dollar Swiss franc? Now, we've had this heavy sell-off in the New Zealand dollar Swiss franc, and that has been for two reasons. First of all, we've had the Antipodeans losing a bit of value with risk-off trading going on. And then we also had that big shift, if you remember, from the Swiss National Bank. And the Swiss National Bank surprised interest rates. That was the move, with a 50 basis points rate hike, which surprised both stir markets and economists. So no one was expecting it. It was 50 basis points. It was big. So that's given it immediate strength in the Swiss franc. That look how long that's lasted, right? That's what we'd expect. I was selling the US dollar Swiss franc and you know, made a very nice little bit of money on that. And I am still bullish the Swiss franc. And any retracements deeper, I'm looking to buy. Now, would I sell from these levels? No. And you can see here when markets get extended, you know, they kind of extend and then they retrace. It's part of the ebbs and flows of markets. They move in these kind of waves. So if you are long here, Ian, because you're thinking, I think it's just extended, it's stretched, I realize, and thank you for pointing out, I realize fundamentally you're bullish Swiss franc, right? Good, okay. Now, what's the risks to this trade? Well, the risks to this trade is if we see heavy risk-off sentiment, then the New Zealand dollar can fall and the Swiss franc can gain. Okay, because the Antipodeans, the Aussie, New Zealand dollar CAD, the commodity currencies, and guess what our commodities are doing? They're falling, and they fall in a risk-off environment. And the Swiss franc, the yen, the dollar gains in a risk environment. Okay, so the risk of this trade fundamentally is that we have global risk-off sentiment, and that will weaken the New Zealand dollar Swiss franc pair. Also, the other risk, Ian, is that we have got an interest rate differential now that favors New Zealand dollar Swiss franc downside. So if we just put the New Zealand, and always look at this, if you want to get the fundamental handle on a currency pair, just put in the bond yield spread, right? So here we see the bond yield spread between New Zealand 10 years and Swiss 10-year yields, right? And what you can see, okay, in your favor, Ian, you can see that that's favoring price to move a little bit higher. Do you see how the way that price tracks the bond yield quite closely? And when you see a divergence, that's when you want to pay attention. So here you can see price moving lower, even though the bond yield spreading higher. So look, you'd expect the bond yield to maybe push New Zealand dollar Swiss franc a little bit higher. So that's in favor. You've got that false break of Harami inside bar moving up. Technically, the major levels you've got to look for is that significant level there and this significant level here. All right, so there are your two kind of significant levels. Now, at some point, I'd expect Swiss franc buyers to lean against those levels to sell. You've got the RBNZ data, which has been a little bit more weaker recently. But you've got the RBNZ meeting this month, if my memory serves me correctly. In fact, let me just see their date, their meeting. Here we go. Yeah, 13th of July. So you've got an RBNZ meeting coming up. Now, the risk here is that they're more dovish. Now, short-term interest rate markets are pricing in a 100% chance of a 50 basis points hike and a 70% chance of a 75 basis points rate hike. So in other words, they have to hike by 50 basis points just to not be seen as dovish. So if they only hike by 25 basis points or they're more dovish, you could see the New Zealand dollar Swiss franc sell off on the 13th. Do you see what I mean? So I like your trade for the reasons, yes, it's against the fundamentals for the pair, but you know, sometimes markets get stretched and you see this kind of stretching action come back. So it makes sense. Yeah, okay, you know, I'll manage my risk by taking 50% profit. Yeah, good. And watch out for those levels. Yeah, and watch out for that risk. Look, momentum is with you, and there's no reason why these can't necessarily push higher. You've also got to watch out for China. If you get like a big resurgence in COVID risk out of China, that could weigh on sentiment. All right. Be helpful if I'm looking at the right. But that would be like a definite, like if I was long New Zealand dollar Swiss franc and I moved into that level, you either want to move to break even ahead of the RBNZ meeting. My instinct is the RBNZ are going to be more dovish. But that's a guess, right? But conditions are slightly less constructive. We had the RBA meeting this week, and they were slightly less hawkish than they had been. So any opportunity to take profit at a good level, I think, like, job done given the probabilities. All right, folks, it's been a pleasure. Thank you all very much. Oh, I am on holiday for the next 2 weeks. So sadly, I won't be back until the 25th of July. So please do come back towards the end of July. I'm sorry I'm leaving you in one sense, but I'm looking forward to getting a little bit of rest, recharge the batteries, and come back fresh, raring to go at the end of July. So thank you all very much for your attendance. Thanks, Ian, for some good questions, and please have a very good rest of the session. Thanks, everyone now. Goodbye.